All right, everybody. I want to review a trade signal that we put out today in Morgan Stanley. As we've seen so far this earnings cycle, the financials have actually put out pretty good reports. Morgan Stanley today, Goldman Sachs, JP Morgan, Bank of America, they've all been pretty decent reports, but expectations have been so high in that space and that sector that the stocks have all sold off. So what we looked at this morning on the Morgan Stanley rally was trying to take advantage of a rally this morning and using the momentum of what has happened in the space so far with the likes of, like I said, Goldman Sachs, JP Morgan, Bank of America, and capitalize on a potential sell-off in Morgan Stanley. So this morning, stock ran up. You can see the high of the day today is 55 actually. We put out a signal early in the day when the stock was on its rally to buy a put spread and try and take advantage of the downside. Okay, here's a chart of Morgan, and you can see right here the 50-day moving average. This was the high today, so there was some resistance there as well. So it wasn't just a matter of getting the feel of the stock was going to sell off because the other financials have. There was technically there's some resistance there. So I wanted to find something very inexpensive with really good reward to risk to the downside of Morgan Stanley. So looking at the option screen, which you can see right now, we put a signal out to buy the May 11th 54.52 put spread. Okay, $2 wide put spread. We put out a signal to buy it at 55 cents with the stock trading 54.90 or lower. Okay, the reason we did that is because at the time that we put the signal out, when the stock was trading about 54 half-ish or so, the expected move that we calculated of Morgan Stanley out to May was about $2.20, $2.30, which, if we got that move to the downside, would put us right at the sweet spot of around $52. That is why we used 52 as our short strike. We always want a stock to move. In a perfect world, we always want stock to move down to or up to our short strike. That way we capture the maximum amount of premium. So we put this put spread signal out there and we got filled, 55 cents. Lo and behold, stock traded up to 55, almost right where we got filled. Had a major sell-off from there. Traded all the way down to 52.93, so $2 off of where we got filled. So from a risk perspective, man, we're looking at this. We say we bought this spread for 55 cents. Maybe I should take some of that off, right? Maybe we should exit some of that. Bulls and bears prosper, pigs go to the slaughter. So we actually put out an exit signal for half of our position. Half of our position, try and take some money off the table, 95 cents. Well, we didn't get filled. This thing traded 91, 92 cents. We didn't get filled at 95. Okay, so we'll reevaluate an exit. But again, the rationale, the reasoning behind buying this inexpensive put spread, inexpensive both from a dollar standpoint and from a reward to risk standpoint, right? $1.45 reward, 55-cent risk, that's pretty good. And we'll see what happens. And we bought ourselves some time. We bought ourselves 3 weeks. So this is an example of what we do here, looking at expected moves, looking what's happening not just in the overall market, but in a certain sector, and trying to pick up and find optimal option strategies based on that momentum. So that's a recap. We'll check in. We'll let you know how we do with this Morgan Stanley signal. Everybody, I hope you have a great day, and we really appreciate you tuning in to Prosper. The legal people tell you I have to say this, so stock and stock option trading involves a substantial degree of risk, may not be suitable for all investors. Past performance is not necessarily indicative of future results. We'll see you tomorrow, everybody.